Turning to Yahoo U, Apple announced in its earnings report yesterday that it will launch a 4-for-1 stock split of its shares. Exactly how does a stock split work, and why would a company do this in the first place? The best person to answer that is Yahoo Finance's Cheung. He's here with another installment of Yahoo U. Class is in session.
Well, Adam, class is in session, and the big news yesterday at the earnings report that Apple is doing a 4-for-1 stock split. And it's important because if you didn't know that, you might be opening your trading account on August 31st, which is when that's effective, and you might be freaking out over an Apple share price that might be about a quarter of where it was previously. So let's break down exactly how this works and why a company would do this in the first place. I want to bring up some slides here just to show you one example of how this might go down in practice. So let's say, for example, I am a company, Cheung Shoes, I sell sneakers, and I want to embark on my own stock split. So one share of Cheung Shoes trades at, let's say, $400 a pop. Now, a 4-for-1 stock split would convert that holding of one share into 4 shares of Cheung Shoes at $100 each. Pretty simple. Now, at the end of the day, nothing really changes about the total value of an investor's stake in the company. It's still 400 before the stock split, 400 after the stock split. But what it does do is it increases the amount of units that you have in that company from 1 to 4. So there are a few reasons why a company would do this, but the first big reason is to increase the float, right? Increase the amount of outstanding shares that exist in the marketplace. Now, in theory, doing so should increase the liquidity of those shares because there's just simply more of them out there. And this is kind of tied to the second point that I want to make here, which is that it also expands accessibility. So at $400, a stock or a share of Cheung Shoes would not have been accessible to anyone that, say, had $200 or $300 to put into the market. But if I can break up my stock into little bite-sized pieces, I can pull a lot more people into the prospective universe of investors. So there's an argument to be made in the sum here that the benefits, though, of this second point are a little weaker than they were, say, 10 years ago. And that is because of fractional trading. So this is available on a lot of platforms, Interactive Brokers, Fidelity, Schwab, of course, Robinhood. And the idea here is that you don't need to buy one whole unit of a stock. So if Cheung Shoes never had a stock split, right, it was still $400 for one share, Julie could say, well, if I don't want to spend a whole $400, I can just buy half of a share, let's say. She's going to put in $200 here. What the brokerage will do, let's say it's Schwab in this case, they'll buy one whole share at $400 and then dole out half of it to Julie, and it's going to hold on to the other half itself. So what does the brokerage do with that other half? It could wait until another person puts in an order just for one half of a share, or it could combine the remnants of a bunch of other fractional orders to create a full share. Think of a leftover pizzas. It can find 8 slices elsewhere and just make it into one whole pizza again. So if people can already do fractional trading, I mean, why do a stock split at all? Well, one explanation is signaling. And to illustrate this, let me flip it and reverse it real quick. This is what they call a reverse stock split. It's the inverse of a regular stock split that I just showed you. So let's say shares of Cheung Shoes trade at $1 each. If you're an investor that holds 5 shares, you have a holding of $5 in Cheung Shoes company. Now, in a 1-for-5 reverse stock split scenario, the company would merge those shares into a single share, which is now worth $5. Again, the same thing. Nothing changes about your total holdings. It's still $5, but now instead of 5 units, you only have 1 unit. Now, why would Cheung Shoes do this, though? If Cheung Shoes shares were at $1, that is pretty darn close to zero. So you might want to give yourself the financial room of having a higher stock price. But the cost of doing this is obviously reducing the float and then opening yourself up to reduced liquidity. So usually moves like this do signal a bit of trouble for the company. And this is the kind of final point that I want to illustrate here, which is that even though there's nothing fundamentally that changes because market cap doesn't adapt when you do these types of financial engineering moves, as a reverse stock split signals trouble, a regular stock split does signal that they expect shares to rise. That's the case with Apple. This is not by any means the first time they've been doing a stock split. This is actually the 5th time. They did it once in 1987, 2000, 2005, 2014, and now August 2020. So the lesson learned, it's a little bit more than just financial engineering. There's actually pretty important financial concepts to be gleaned from actions like this. Julie, Adam?
Brian, in the words of Homer Simpson, pizza.